Hello, my name is Mike Sinibaldi and welcome to this week's video edition of Heard on the Street. In this edition, I'm going to take a look at the following markets: the Emini SP futures, corn, wheat, soybeans, oil, the euro-US dollar pair, and at a request of a reader, gold. As I reviewed the markets on Saturday morning, I realized that many are on the brink of big moves or are already working third waves. In this week's video edition of Heard on the Street, my hope is to identify key areas where significant opportunities may exist. As evidenced by the CRB Index, many commodities are making explosive moves to the downside. Gold, copper, and oil, and the grains are just a few. As you will see shortly, deflationary pressures may be reasserting themselves. The first market that I'm going to talk about is the S&P. At the weekly chart level, the market continues to test the trend line and the 200 period simple moving average. For the week ending July 1st, 1260 is where the line crosses. Also note that the most recent 2 weeks have resulted in nothing more than a weak bounce that has a high probability of being fully retraced. Nearby support remains 1241 to 1246, with deeper support lying at the .382 retracement of 1229 of the rally that began from July 2nd to May 6th. Remember that level because it's important. At the daily chart level of the September contract, the market has been following this analogy that I laid out on June 1st. As you know, I've been pounding the table on these levels day by day, tick by tick for almost a month. The only question is whether Wave 3 will end at 1228.50 or 1222.75 as seen in the ES1 contract. If you recall, 1229 was the .382 retracement level at the weekly chart level. Since 1228.50 is obviously higher than 1222.75, 1229 to 1228.50 is the obvious place to look at for a Wave 3 termination. The next market that I'll be covering is the grain complex: corn, wheat, and soybeans. The grains are very exciting as each market has a tradable pattern. Corn is currently working Grand Supercycle 4, a flat correction at the cycle degree. A, B, C, where C should end below Wave A. Corn has just completed Wave B of the larger degree flat pattern in an ending diagonal. If the labeling is correct, then price should fall to 520, the previous fourth wave, where the pattern began, and take less time than it took to build. From a time perspective, Wave 5 took 27 weeks, so look for a full retracement of Wave 5 to occur between August 19th to September 16th, plus or minus a week. Price has reached key support, and the market is oversold. Near term, prices may push lower to 608 to take out all the nest of stops that have accumulated below before moving higher. The next market that I'll cover is wheat. Wheat is working in what I believe to be a head and shoulder pattern within the Grand Supercycle Wave 4. The left head and right shoulder. Target measurements are typically associated with the distance between the head and the neckline projected down from the break of the neckline. If you do this exercise, you'll arrive at a termination point where Wave 3 equals 453. The next market I'll cover is soybeans. Unlike corn and wheat, I'm looking higher in beans. Currently, Wave 4 is developing in a triangle, needing another 3-wave sequence up to complete Wave D, followed by another 3-wave sequence down to complete E. A print below 1270 would negate this view. Thereafter, beans should thrust higher in a final impulsive move to my estimated target of 1529 that completes cycle Wave B and aligns the entire grain complex together. Once Wave 4 completes, I can firm up the Wave 5 targets. The next market that I'll cover is oil. I'm very excited about this market, and oil offers a great trading lesson. Readers know that my long-term assessment of this market is bearish, yet my near-term view called for oil to rally to 107 before the larger trend down would resume. This week had a lot of volatility due to the Department of Energy's release of oil. Was this event telling us how weak the Fed really thinks the economy is? Was this the coordinated global effort to avert Armageddon? What do the charts say about the long-term prospects for oil? That's what I want you to consider. Price has fallen sharply below the typical 1.382 reverse Fibonacci extension to 91.8. Prints below this level often indicate that the near-term analysis is wrong. Knowing this, I began looking for an alternative count that would better explain the recent price action. Here is the chart showing the effect that the Strategic Petroleum Reserve release had on WTI in 2005. Notice after the release, prices recovered, then collapsed to $56. My purpose in showing this chart is to determine whether the model that I laid out for an expanded flat wave 2 at the daily chart level is still valid that would draw prices higher to 107 before failing. As you'll see, I no longer believe this to be the case. Here's my updated forecast for oil. My initial assessment for calling for a top is correct, but Wave 2 completed at 103.375 and Wave 3 is underway that eventually will draw prices to approximately the 71 handle, where Wave 3 equals a 1.618 multiple of Wave 1. But prior to achieving that milestone, a critical area must be breached to confirm that a top is truly in place. If you notice, the previous first wave termination point is 82.95. Once prices print below this level, wave overlap will occur, and anyone trying to force a wave 4 interpretation that began from 114.77 will have their pattern negated due to the rules and guidelines of the Eliottwave Principle, as wave 4 cannot enter into the price territory of wave 1. You might have noticed that wave C of wave 2 ended in truncation, where wave C is below the unlabeled wave A at the weekly chart level. I personally don't like to use a truncation unless it's absolutely necessary and fits the wave structure, because if you're wrong, your trading account can sustain damage quickly. And here's the same view at the daily chart level with wave A labeled. But how do I know that wave 2 really ended in a truncation and I have the right wave count? Well, I can look at the forward contracts. Feel free to look at the monthly expirations through March of 2012. They all show the same truncation. However, here's where the rubber meets the road. The April and May 2012 contracts actually reached a new high to complete wave 2. Here is the April of 2012 contract. Notice that the equivalent wave 3 would come in at 79.49, and here's the May contract and its corresponding wave 3. The next market that I'll cover is the euro-US dollar pair. At the weekly chart level, the euro has made a 1-2 sequence. The degree at this juncture is not important, but what is important that support below the market exists between 136 and 137. Turning our attention to the daily chart level, wave 3 is underway, and more specifically, a third of a third forecasts an acceleration to the downside. I labeled the charts as I expect price action to unfold, where wave 3 circle equals a 1.618 multiple of wave 1 circle at 134.38, and where wave 3 red equals a 1.618 multiple of wave 1 that terminates at 1.325. A print above 144.41 negates this view, but only a loss of 146.93 implies that wave 2 was still unfolding. The final market that I'll cover is gold. When analyzing gold, I often look at the gold Aussie dollar ratio and gold US dollar ratios to get a general direction for gold. Currently, the gold Aussie ratio is bearish. As the ratio implies, the ratio can only fall when price of gold falls faster than the Aussie dollar or the Aussie appreciates while gold remains stable. From an Elliott perspective, the wave count and pattern confirms lower prices for gold. I'm working a double zigzag that should resolve to the downside, where wave C equals wave A at 1093. W, X, Y. There are other possible ways for the pattern to resolve, but all confirm lower prices. Turning our attention to the chart of gold, the yearly chart shows how the market has reached a significant 1.618 level. Almost always a move of this nature is retraced once reaching this level. I've added the support levels on the chart as well as which levels are more significant to watch. Drilling down to the monthly chart level, notice that the trend line remains unchallenged. Until this level is broken on a closing basis, traders should remain cautious this market, keeping size to a minimum. The first level of market support is 1473.70. At the weekly chart level, it's easier to see why a case may be made that gold is forming a top. First, notice that we can count 5 distinct waves from wave 4 circle. 1, 2, 3, 4, and the subdivisions of wave 5 of 5. 1, 2, 3, 4, and 5. 3 additional pieces of technical evidence confirm that a top may be in. First, price shows multiple divergences between price and the MACD. Notice how the MACD values were declining as price were rising in wave 5. Also, if an analyst considers 1576 the top of wave 3 instead of wave 5, then the MACD signature would have a higher value than 6306, and it doesn't. 6306 versus 5107. Combined, this has me leaning towards a more bearish than bullish posture. Secondly, rate of change also shows divergence. As prices rose, momentum waned. Furthermore, RSI reached levels associated with the ends of bull waves, as it did here, then pulled back to find support between 40 and 50, and again here at the 1576 top. The indicator is once again falling, and if my assessment of the market is correct, RSI will fall to a level below 40 to confirm the bearish view. Finally, here are the subdivisions of gold at the daily chart level, as well as the key expansion levels to the downside. In my opinion, there is nothing impulsive about the price action from 1462.40 to 1559.40. Price remains within the corrective price channel. It's sloppy and choppy and contains numerous overlapping waves. Therefore, the evidence has me looking for further selling pressure that is aligned with the weakness seen in the euro-US dollar. I hope you found this video helpful, and best of trading.